Hey, good afternoon, everyone. This is Mark from Right Line Trading, and I really thank you for taking the time out of your, it's a busy day, and probably most of you have been trading today, and coming in for this webinar. And just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years. I began trading the futures and forex markets about 10 years ago, and my area of expertise actually is the optimization of software systems via mathematical modeling. In college and graduate school, what I did was, back in the olden days, we would take multivariable equations and we would optimize them for for sensitivity, specificity, and positive predictive value. And one of the projects I worked on was with the U.S. Navy in optimizing underwater decompression schedules. Deep dives. As you come up from a deep dive, you have to keep. There's a speed with which you make your ascent, and also you keep changing gas mixtures. So we created a multivariable equation. Optimized it to get the diver up as fast as we could, as healthy as possible. And then when I became involved in the futures and forex markets, what I did was essentially create a multivariable equation for trading, looking at what I thought were the most important independent variables associated with obtaining a successful system-generated trading entry, and then look to optimize those variable by variable, and through an evolutionary process. That's the software I'm going to show you today, and that's what we use at Right Line Trading. And just let me move the slides down here. Now there's different strategies that people employ for taking trading entries, and they're really very, very strong proponents of price action. And these are traders that believe that price action alone is enough to trigger a buy-sell recommendation with a high enough positive predictive value to make you a successful day trader. In other words, the sensitivity and specificity of the buy-sell trigger is exceedingly good, so that it doesn't get you into very many false positive moves. There are others that believe that some unique composition of indicator signals, some confluence of indicator signals, can trigger a buy-sell recommendation with enough power and precision also to make you a profitable day trader. Now, at Right Line, we believe that neither one of these alone provides you as a standalone with enough information to get you where you need to be. Looking at indicator analysis, I don't believe there's any software invented that's going to give you a blue dot go long or a red dot go short system-generated entry with a high enough predictive value to make you profitable. I don't believe it's possible, just based on indicator analysis. If there was, there would be some magic in indicator confluence that provided you with such precision system trading that you could just hand it over to a robot and system trade for millions in profit. But I don't believe that exists, and I do not believe that price action alone gives you enough information at all. In fact, I think price action provides 75% of the information. As a standalone, it's not enough to give you a buy-sell trigger. So we believe you have to combine both. You have to confirm what price action tells you with indicator confirmation. Now, there's a further subdivision, and those are people that trade one time frame, and those that use higher time frames to confirm the validity of their entry, and we definitely believe in that. And that's known as fractal analysis. And that's where you use multiple time frames to confirm the validity of your trading chart. And those are usually higher time frames. You want to trade with the trend. You basically use the higher time frames to help define your trading entry. But what we have done, and you're going to see, is that we have many of our indicators synthesize data from multiple time frames and project that onto your trading chart, so that when you see a system-generated signal, it's based on the analysis of it's a multi-time frame analysis, and that provides you with much more trading power than simply using indicators that base their signals on your trading chart. So, as I said, we don't believe that price action alone is sufficient. We don't believe that any confluence of indicator signals is sufficient. And like I said, if these were true, somebody would find the Holy Grail, and we would be able to robot trade the market for millions of dollars in profit. Unfortunately, it's just not that simple. Now, in deciding what parameters are going to go into your multivariable equation, you have to understand the market. You have to do a lot of background work. I mean, what specific parameters are key to go into that multivariable equation to optimize? And basically what you're looking for is significant independent variables. And at Rightline, we believe the significant independent variables consist of one, market structure, and price action. And I think that that's a very significant independent variable. Another independent variable is indicator analysis. We're going to go more into that because you have to decide what indicators are important independent predictors of a trading entry. And I've seen various pieces of software that'll have multiple MACDs, multiple stochastics, a lot of redundant indicator analysis. And in no way do I believe that the addition of 2 MACDs increases the precision or predictive value of the trade. So how you format your indicator analysis is important. And in addition, you must do fractal analysis. You either can sit with 2 or 3 or 4 charts on each individual market, or you can have your indicators synthesize the data for you and project them on your trading chart so that it's really done in a simple way. It's very intuitive. And you basically can get a very good feel from seeing which direction the market's going to move. And you can get trading entries, and these are system-generated trading entries that provide you with remarkably accurate, that are remarkably accurate. They come with a tremendous amount of precision. Now, our methodology, essentially, and actually this is really our dogma, is that we are trend traders only. We don't trade tops or try to call tops or try to call bottoms. I mean, we believe that it's impossible to do. The market can continue to move up, and if you've been day trading the markets for a significant period of time, you know that MACD divergence and stochastic divergence sometimes work and sometimes doesn't work. And that is not good enough. There's no way to call a top or a bottom with any kind of precision to make those calls lucrative. In addition, and basically it's a way of saying the same thing, we don't trade reversals. We don't look to trade a reversal in the market, i.e., essentially, we don't counter trend trade. We look to trade with the trend. And we never try to predict breakouts. Now, breakouts can be predicted by price action. They can potentially be predicted by indicator analysis. But I don't believe that there's any software that can do it, again, with the precision that is required by the market to make you profitable. Because there are too many other things that we have to overcome, and the one thing that we must do is trade with a huge amount of specificity. And I just want to mention that really briefly. after I talk about being trend traders only. So we believe that institutional traders set the trend, and we want to be on board with them, and it is our goal to have the software define a trend and take a retracement into the trend, so to get on board that trend at a very, very safe area and look for a trend continuation signal in a clearly defined trending market. We stay away, and when you look at the indicator system, you're going to see it really, really well defines CHOP. Now, there are people who try to trade with a lot of sensitivity. And sensitivity is true positives over true positives plus false negatives. And if you trade with a lot of sensitivity, you're going to get pulled into a lot of false positive trades. And that is not the way to become profitable. The way to become profitable is to trade with a huge amount of specificity. In other words, you want to be ultra-conservative traders. You want to weed out the false positives, and what you want to do is be able to ascertain which are the true negatives. And the only way to do that is to trade with a significant amount of specificity. Now, in order to do that, you're going to have to let a lot of moves in the market that, quote, are successful go by you. Sometimes the market's going to make a significant move. But because price action, market structure, and indicator confirmation simply don't align, we don't chase those trades. What we're looking for are 2 or 3 perfect setups a day. Ones that align with everything that we've defined as important independent variables, and stick with those trades. And that is the way to become a profitable day trader. To have tremendous patience and just adhere dogmatically to your trading rules, and never chase a trade. Now, if you take a look at a chart with price action, I think that you get a lot of information from it, but there's just not sufficient information to become profitable. And I just took this snapshot at random. To be honest with you, I didn't look for anything special, and this is a snapshot of crude oil from March of 2014. And what you can see is that, I mean, this is the market moves up and then comes right back down, and this is 100% retracement. And then you get a confirmation engulfing candle that tells you that the market's going to, it tells you that buyers are really moving into this candle with a lot of conviction. They don't give the sellers an opportunity to even create one tick of wick. And it really is at a swing pivot low, and the market's going to move up. And then it swings down again, and you get a 100% retracement right back to the top. And you get the same thing. You're at a pivot high. You get an engulfing candle telling you that sellers have come into this market with tremendous enthusiasm. The buyers are only able to create one tick of wick to the upside. Sellers just slam the market down, and the market does head down. Now, I mean, obviously, we need to analyze price action and market structure if we're going to take successful trades. But as standalone signals, this is insufficient data. And we have an indicator that analyzes market structure and price action from 2 higher time frames and projects that onto your trading chart. And you'll see that when I move to the platform. It's a terrific indicator, and it's one of the few indicators that I've ever seen that is totally unaffected by anything that goes on your trading chart. All the data that goes into that indicator only comes from higher time frames. So in essence, if there was ever an indicator that provides you with a look ahead, that's it. Because it's looking ahead for you at 2 higher time frames and basically giving you the heads up as to where it believes the market's going to go. Now we further divide price action market structure with a 50-period simple moving average. And when the moving average is green and heading up, it's green when it heads up and red when it heads down. Now, we believe that when price is above the 50, the bulls are in control, we go long. When price is below the 50, the bears are in control, and we go short. Remember, we only trend trade. So we take longs above the 50, and we take shorts below the 50. We don't look for the moves up. We don't go long on a reversal off a swing pivot low. A lot of them work, but a lot of them don't work. And as I said, 60% that work and 40% that don't work is going to land you in the poorhouse really quick. You need a 70, 80 to 90% sensitive and specific signal in order to be profitable. Now, we add to this a proprietary trend line. It's a 15-period moving average, and it really helps us define chop. And again, you're going to see that when we move over to the platform. Now, when the 50 is red and the 15 is red, that's really the only time we should take a short. When the 15 is green and the 50 is green, that's really the only time that we should take a long. Now remember, 10% of trading is discretionary, and you can see there are going to be certain times when you can bend the rules a little bit, and we have an auto trader that does this as well. But our discretionary trading in the room almost always beats the auto trader. Now, the auto trader this month has taken 7 trades and had 7 wins. It's just working terrific. But in general, our 10% discretionary ability to bend these rules just a tad actually gives us a slight advantage over a robot trader. But the rules are 50-15 down, short, 50-15 up, long. Now what we also found was that the distance of the candle open to support for a long trade, or off of the 15 or 50 off of resistance to the downside, plays a significant role. It's a major independent variable in the predictive value of your entry. If you take a trade, and what we did was we optimized for it. If you take a trade, and what we found was that the trading entries that occur with the candle body more than 4 ticks off of the modified 15 we call it, which is our proprietary 15, or 4 ticks off the 50, start to fail with increased percentage of those trades fail. So we created an indicator that tells us how far the candle body is from the modified 15. That's a very important variable, because what can happen to you if you take a long trade and the candle body open is 7 ticks off of support? It can retrace right back to support, stop you out, and then continue. So you want to be so tight to your trend line that you don't give the market to fall back to support. You're trading off the support. Same thing for resistance. You want to trade off a resistance to the downside without giving the market an opportunity to retrace back into resistance for another move to the downside. So we stay very tight to our trend lines, and we have an indicator that defines that for us. Now, in terms of indicator analysis, these are what I believe to be the 3 most important indicators. And you're going to see that this is how I created the platform, but it didn't ultimately turn out to be the case. Now, order flow is extremely important, and that is defined in line 1 of our 3-line indicator. Now, stochastic, since I created the slide, stochastic is really line 3 and momentum is line 2. But you're going to see that's really irrelevant, because all of this information is projected right onto the price bars. So you really never even have to look at the 3-line. But I just want you to understand what it does and how it arrives at its analysis. So when you see the information projected onto the price bars, you know what's going on. Now, it does fractal analysis. It analyzes data from multiple time frames. So when the line is red on the first line, it means that order flow is down on all time frames analyzed. When the second line is down, it means that stochastic is down on all time frames. And when it's red on line 3, it means momentum is down on all time frames. When it's green, it's just the opposite. It's up on all time frames. And that's what we look for. We look for the alignment of multiple time frames. Now, just for your for knowledge, when it's orange, it is up short term and long down long. It is moving up short term. It is down long term, and we believe longer term time frames rule. So we colored that orange. And when it's blue, it is down short term and long up term. So and since the longer term time frames rule, there's still an up bias. But what we really look for is alignment, either all red or all green. But you're going to see you don't even have to look at the 3 line in order to trade with it. We've made it really easy. Now there's one other parameter that I want to show you, and you're going to see this in the upper left-hand corner of the chart. Now I don't really use the slope of the 50 or the slope 15 or the slope of the 50. I do use the slope of the modified 15, but I'm really not going to get into that too much in this webinar. But like I said, we want the slope to be red on a short trade. We want the slope of the 50 and the 15 to be green on a long. What's really important on the slide is the MA diff. Now, let me show you what the MA diff is. Now, everybody takes for granted that an oscillator accurately defines an overbought, oversold market. And the one problem of this area, it really lacks scientific study. I mean, most of what we believe to take place in the market, what we are taught that indicators do, is simply a given. But there's really no prospective studies. There's really no dogmatic scientific analysis to determine that what we believe to be true is actually scientifically correct. So what we did is we looked at a year of market replay data to determine what really defined an overbought, oversold market. Because of all the indicators, I don't want to get too complicated or talk too fast, but of all the indicators that you look at, the oscillator indicator is the one that people interpret differently. Now, nobody's going to trade in the opposite direction of the MACD or momentum. Nobody's going to trade in the opposite direction of order flow. That's a given. But what do people do when the market's overbought on an oscillator? Some people will continue to buy. They believe that when the oscillator is overbought, you continue to buy over each pivot, each high pivot that's broken, you continue to buy because it tells you that bulls are in control. The same thing when the oscillator is oversold. It's telling you that bears are in control and to continue to buy breaks of additional pivots to the downside. And then there's the camp of people that believe that when you're overbought, look for divergence, either oscillator or MACD divergence, and go against the oscillator. Because the oscillator is predicting not a continued move up, but a reversal. So you have two groups of people, and I'm telling you, it's pretty much divided in half. Half the people continue to buy an overbought market and sell an oversold market. Half the people on an overbought market look to short, and half the people on an oversold market look to go long. So who's right? So what we did was we looked at a year of market replay data and found that everybody's right and everyone's wrong. The oscillator does not accurately define an overbought, oversold market. What we did find is that what did define an overbought, oversold market was the space between the 50 and the 15. As the space between the 50 and the 15 widens, the predictive value of the trades begin to fall. It makes no difference what the oscillator tells you. That is a fixed parameter. And on an 8-range chart, which is what we trade, we determined that the MA diff, or distance between moving averages, which is the 15 and the 50, should be 18 or less. So it should be 18 ticks or less. So this is another independent variable that we put into our equation and optimized. So we look into the upper left-hand corner of the trading chart, and we look at the MA diff when we trade. Now, if the MA diff is 18 or less, we know the market is not overbought or oversold because the distance between the 50 and the 15 is 18 ticks or less. Now, does that mean you cannot take a trade with an MA diff of 20? And the answer is no. The The role of the software is to define risk. And if you believe that you're trading right off of support to the upside, right off of resistance to the downside, you have order flow and momentum with you. You're going to see you have background bias. You have multiple parameters that define risk in your favor. You may allow that MA diff to widen. But that's the important parameter we look for an overbought, oversold market, not the stochastic. So the stochastic in the 3-line has been eliminated as any predictor of a trading entry success. And the data that's assimilated and projected onto the price bars doesn't take into account the oscillator. Now let's take a look at a chart. And let me show you this one. It's a little bit easier. You can see that we only trend trade. We want the 50 green. We want the 15 green. Now all this analysis is done intra-bar. So on this candle, as it begins to form to the upside, you're going to see that blue rim, that blue halo around the candle. And you're going to know that you're going to have order flow and momentum with you on the trade. And remember, this is multi-time frame analysis. So order flow and momentum are aligning for you on multiple time frames to the upside. And at the close, before the candle closes, you're going to put in a buy stop or buy stop limit order. The candle closes, it moves one tick above, and you're in the trade to the upside, and up you go. And the reason we use a buy stop or a buy stop limit is that at the top of every candle, right here is a small area of resistance. We want to break the candle high by one tick and then trigger the trade entry. The same thing for a short. We want the 15 and the 50 to be down. You see the candle breaks the 50, and candlestick dogma going back 2,000 years tells us when 2/3 of the candle body breaks a trend line, that trend line is broken. So this candle breaks to the downside. It's rimmed in yellow, which tells you that order flow and momentum are with you to the downside in multiple time frames. And down we go. You're in one tick below the close of the candle. Your sell stop or sell stop limit order has been placed before the close of the candle because you know that yellow rim is going to be there if the candle closes, prints, and jumps one more tick. If it doesn't mature, that sell stop or sell stop limit order is never triggered. Just cancel it. Here's the same thing again. Here's a break of the 15. The last two trades I showed you were breaks of the 50. 15's down, 50's down. The candle breaks the modified 15 to the downside. It has order flow and momentum. This has order flow, stochastic, and momentum with us, but we know that the addition of stochastic doesn't really have any predictive value and doesn't add to the precision or power of the trade to the downside. So one tick below the close of the candle, we're into the downside, and we have a nice move. Now, here's where I think the power of our trading system really comes into play. Now, the C candle entry is our most powerful entry, and it's really remarkably powerful. And when you see it in real time, I think you're going to be very impressed with it if you had. And here's what we do. We look to exploit all of the other traders who try to call a top or a bottom, try to counter trend or try to counter trend trade. So what happens is, now the A, B, and the C are all created by the software, not by me. I didn't type them in. The A defines a trend, and the trend is any two candles of the same color that occur in continuity. So two red candles in a row define a trend, and the A prints. Then you're going to get a continued move to the downside. And then what we look for is a B. And a B is a pull-up candle in a downtrend or a pullback candle in an uptrend. So what's going on here? Now you can make your B any color you like. I just like to make mine purple, but you can color it anything you like. But this is a blue candle, an up candle in a downtrend. Now, these are all buyers trying to buy the market in a downtrend. And they're trying to call a bottom, they're trying to call a reversal. So what we wait to do is for them to be engulfed by a C. Now the C starts to flash when there's the potential for this candle to engulf. And it just continues to flash. And as soon as you see a flashing C, our range maker tells you where the candle's going to close. You put your sell stop order here, or sell stop limit in. Your 50's down, your 15's down, and you're in one tick below the close of the C. Now, what's so powerful about these trades is that they are propelled forward by two forces. One is the addition of more buyers, sellers simply piling into the downtrend, but also it gets pushed down by the fact that as soon as this candle breaks the low of the C, that breaks the low of the C, it starts stopping out all the people in the B candle. And that really does push these trades, sometimes super fast. So what we're doing is we're trying to exploit all these counter-trend, bottom-calling traders. And if you look, that's really the basis for the whole market. And if we didn't have people counter-trend trading and trying to call a bottom or a top, it would make it impossible to trade. And you see, here's the same thing. There's the A, the B candle, and this is the only audible signal on the chart. When a B prints, you get a beep. That alerts you to the fact that there's the potential for a C. And if the C prints and engulfs, it's tight to the modified 15, 4 ticks or less. It's engulfed in pink here, which shows you that you have order flow and momentum with you on the trade. You're in 1 tick below, and this thing is shoved down by the addition of new sellers piling into the trend. And a lot of these are institutional people, because it's the institutions that set the trend and why we don't want to counter-trend trade. And also all of these unfortunate long positions get stopped out. And here's the same trade again. I mean, we can't take a trade when the 50's up and the 15's down. Now that prevents us from getting into a nice move, a nice down move. And in fact, you get a break, you get a retracement, and then a move to the downside. But it does not come with the 50 and the 15 red. So we have to step aside on the trade. Remember, we trade with specificity, not sensitivity. We're not looking to get into every move. What we're looking to get into is to every successful move. So we wait for the market to break here, retrace right back into the modified 15 with the 50 down, 15 down, C candle, and down we go for a winning trade. Now, this is just what I'm going to show you are really just all variations. These are not C candles, but it's the same principle. This is called the momentum signal. And the momentum entries are excellent entries. They show you that momentum is aligned on additional time frames above and beyond those analyzed by the 3-line indicator. So you get a break to the upside. There's the red candle. These are the traders trying to call a high, trying to push the market down when it's in an uptrend. They're not quite overrun, but the uptrend is confirmed by this candle. It moves to the upside with order flow and momentum in its direction. The momentum signal tells you that momentum is aligning to the upside at the close of the candle, and you're in 1 tick above the close. Same thing happens again. Moves up. There are our sellers that we want. They push the market back into the modified 15. We trade right off support. We get a system-generated confirmation of the trend with the X, and ultimately we run over all these sellers who are trying to counter-trend trade. And again, the same thing. We get the break, and if I have 200 YouTube videos, and most of the trading sessions that take place in the trading room, the live trading room, I record. And basically, I mean, my mantra is the break, the retracement, and the continuation trade. This is the safest place to get into a trend trade. It's not to just jump on board any place along the move, because at any time the market can retrace. Remember, we're trading way off a resistance. We want buyers to come into this move, to try to counter trend trade it, to try to call a bottom and push the market right into resistance. And then for the downtrend to be confirmed by order flow and momentum and a system-generated signal like a momentum signal. I mean, this is a really easy system to trade because it's really based on the same principles that work on any time frame, any market, any kind of bar, time, tick, rank, go. It's all the same. Again, it's the same trade. The break, the retracement, and the continuation long. This is a third kind of entry. It's called a power entry. Now, of the three, this has the weakest predictive value, and you have to be the most careful with these. The C candle's the strongest. We have a momentum signal, we have a strategy signal, and then we have a power entry. But if you get a great move to the downside, there's the retracement. 2 green candles, trying to call a bottom, trying to counter trend trade, right into the modified 15. These are the really great trades. When the candle comes right off a resistance to the upside. The downtrend is confirmed by the arrow and by market structure. We're trading right off resistance. In this particular case, I don't have the 3 line on the chart, but I would imagine that we're trading with order flow and momentum. And then we get it happens again. Buyers push the market right back into the modified 15. We get a confirmation of the downtrend. We're in 1 tick below the close. And it happens a third time here. You get a move down. Here come buyers again. Pushes you right into resistance. We're in 1 tick below the close of the down candle, and down we go. This is a strategy entry, same principle. Move to the upside, retracement. Strategy entry confirms that the uptrend is intact at the close of the candle to the upside. We're tight to the modified 15 on a move to the upside, and up we go. Now, this I think is really maybe one of our most innovative indicators. And what we did is we added background bias. And what background bias does, this is the indicator that is not influenced by any price action or indicator analysis on the trading chart. What it does is it analyzes market structure and price action from 2 higher time frames. So when price action and market structure align on 2 higher time frames to the downside, you get pink. When price action and market structure align to the upside on higher time frames, you get along. Now the thing is that since this color is totally independent of the price action that's going on the chart, you can see that it really does predict the market move. It turns pink, and that tells you that you have 2 higher time frames, price action market structure, heading to the downside. And it's not even looking at your trading chart, but price falls. Same thing with green. And I think it's a really remarkable indicator. Now, if you trade with a signal that is order flow and momentum with you, tight to the modified 15, with background bias, I think the predictive value of those trades are close to 90% if you stay extremely conservative. That means you trade with the most specificity, you're going to have the highest precision, but you're also going to miss a lot of trades that go. But so what? Let them go. If crude oil moves 35 ticks and it doesn't meet your entry criteria, let it roll. Let other people chase it. You create your trading style. You know what you're looking for. We give you the rules. Remember, 10% of trading is discretionary, which is why blue dot longs and red dot shorts do not work and never will, because 10% is your ability to ascertain pattern recognition, to look at the chart, take it in its totality, and decide whether you want to go short. And it takes time and work. I mean, you're not going to become a successful day trader in a minute. And no piece of software is going to throw a consistent winning trade in your face over and over and over again. And the people that tell you that are just giving you a lot of bull. We have a lot of successful traders in our trading room, and they work really hard. Every night, they go back to the charts. And today, I had a losing day in the room. and it's one of the few losing days I've had in the last 6 months. But the thing that I'll do tonight is go over every single trade and analyze every single thing that I did, every entry I didn't take and every entry I did take, to ascertain what did I do wrong today and try to make an adjustment. So let me go over to the actual trading platform. So hold on 1 second. I'm going to reshoot the charts, and I'm going to show you our trading platform. Yeah, you're missing one. Get going. There it is. Okay. Now, here's the actual trading platform, and let's go through. Let's go through the Russell. Now, we used to trade an 8 range, and just recently we moved to a 13 range. And I found the 13 range, the adjustment's a little bit difficult because we don't get a lot of good setups on a 13 range. But what we're looking for on a 13 range is we trade 3 contracts, 2 off at 10 ticks and 1 off at 20. Now, our direct entry system allows us a really, really unique advantage. We can take a trade on a 1-tick pullback. So our initial stop is 15, it goes to 14. Our initial target is 10, it goes to 11. And our initial second target is 20, it goes to 21. So what that tilts is the risk to reward. On a winning trade that goes 20 or more, we make $430. On a losing trade, we lose $420. So we actually make more on a winner than we lose. So if we take a loser, only one winner wipes the loser out. So let's take a look at the whole day. And basically, here's your first trade, right here. It's really just like I showed you. You get a move to the downside, a retracement right back into resistance to the upside. You can see the candles outlined in yellow. That occurs intra-bar. And then the continuation to the downside. Now, on a 13 range chart, this trade would have gone 27 ticks. And we would have had 2 out at 10 and 2 out at 20. I'm sorry, 1 out of 20. And that would have been a $430 trade. Now again, we look for, in this area here, there's no bias. And without bias, you can see how price action breaks up when there's no alignment of market structure and price action on the higher time frames. It gets very choppy on our trading chart. Now here's another trade. Remember, we need to, now this is a risky trade. I don't like taking trades where there's only 1 ticket candle body because it doesn't tell me I have a lot of selling conviction. But you could take this trade right here. You get the break, the retracement, and the continuation short. Now it doesn't have order flow and momentum with it. That's another area which is a little risky, but it goes 29. If you wanted to stay very conservative, this would be your only trade on the Russell today, right here. That gives you everything. Then we lose bias. And you see price action breaks up. It becomes very choppy. System-generated signals, some work and some don't. See this trade right off the 50? This is a huge winner. This trade here, right off the modified 15, another big winner. The one thing you don't see, though, is you don't see losers. It's just a matter of defining what you feel. Yeah, this is gold. I'm sorry. Did I say with the Russell? You're correct. Now, here, we're trading into a pivot. We never trade into unbroken pivots. So this would be an entry we would not take. Order flow DC is measured by looking at the number of executed buys, buy contracts across the tape versus the number of executed sells that cross the tape on a given tick, and compare it with the number of executed buys and sells in the previous tick. So let's say on a long trade, if the number of executed buys on tick 1, if the number of executed buys on tick 2 is greater than the number of executed buys in tick 1, and the number of executed sells is less in tick 2 than the number of executed sells in tick 1, and it's based on the ratio, then order flow we consider to be moving to the upside. So it's really telling us that there's more buying pressure than there is selling pressure. More people are executing buys than they're executing sells, and we just compare one tick to the next tick to the next tick. And as long as those buys continue in our direction, on multiple time frames, our order flow indicator stays green. Now remember, to take a short trade, we need the 15 below the 50. For a long trade, we need the 15 above the 50. And we've got all kinds of moves here. This is a yellow modified 15. We can't take it. And right here is the trade. So I went over this in the trading room. We have the move, the retracement. It gives us everything that we want. We're trading with bias to the downside, order flow and momentum. We have room to our first target before we hit the pivot. And we have a really, really big move to the downside. Now, if we took the more aggressive trades, that went 34. Now, this is very, very tight to the 15. This is a hanging candle. If you look at the distance between the 15 and the candle body open, it's 9 ticks. Now, it would have worked. It would have gotten the first target. But I wouldn't have taken the trade because, remember, we want to trade right off resistance. This candle's right off resistance. Now, here, the market's oversold. Remember the MA diff on a 13 range, we want it to be 28. Here, the MA diff is 50. So we're not going to take this continuation long, short. Now we're just going to let the market go. Here's a trade. The break. There's the retracement. It's a little bit of a hanging candle. It's not as tight to the modified 15 as I would like it to be. Goes 14 ticks. And that's it. So gold today, we had multiple winning trades, and if we stayed ultra conservative, trading with bias, order flow, and momentum right off of support or resistance, we would have clocked in no losers. Unfortunately, I didn't do that today. I was very sloppy. And I had one of my very rare losing days today. But you can see that if you stay conservative, you just rarely take losers. And let's take a look at the Russell today. Let me just take this off. The Russell opens. You see no bias. Market action, price action here, very, very choppy. You take a trade here, you know, it's like you better hang on to your chair, because that's a very, very dangerous place to trade, because it's telling you that price action and market structure on the higher time frames are not aligning to the downside. So taking a short trade here is very, very dangerous. Now here's where we get the signals. And we want to stay ultra conservative. Remember, this trade is way off resistance. It's 15 ticks off resistance. We don't want to take that trade. We don't want to take this trade either. Now, in real time, the indicator does this for us. That's 10 ticks off resistance. This trade is 6 off resistance, and it has to break the pivot. So unfortunately, we have a big move down, but because we trade with specificity, none of these meet our requirements. So we got to let this big trade to the downside go. But it doesn't make any difference. Now, nothing's aligning. We're overbought here. There's nothing to buy. Now we lose bias. When we lose bias, we should lose interest in the market as well. Now, I took this trade in the room, and it was really a very risky trade without bias, and it went 18 ticks. Again, big move to the downside, no bias. You could take it, but it's risky. Remember, you have the 15 down, the 50 down. You have order flow and momentum. And remember, the platform defines risk. If you feel comfortable, you have your down move. But it's a 75-tick move. But you're trading with a lot more risk. Now, if you want to eliminate risk or minimize it, you're going to trade with bias. And here's your move. Whoops. There's your B candle, retracement, and a gigantic move to the upside. Not much on the Russell today. And now let's take a look at crude oil. The key, though, is if you trend trade, trade with background bias and trade with order flow and momentum. And remember, this is multi-time frame analysis. You're going to get very rare losers, even though you may have to let some nice trades go. And remember, if you trade, we trade 6 markets at the same time. If you trade 3 contracts and get 2 trades that go 20 ticks or more, you've finished the day with $860 of profit on 6 round trips. So sit and wait for the most perfect trades possible. And don't chase. Like this entry, don't chase an entry that's so far off of resistance. We know we want it to be 4. Why would you take a trade that's 14 ticks off? Now this trade is a really nice move to the downside, but it's right into an unbroken pivot, and it does make a nice move to the downside. But why? We just if you believe that pivots turn the market, and we see that they do, because we've done a year of market replay data, and if you trade into unbroken pivots, it really hurts your equity curve. You're not going to trade that. If it breaks the pivot, fine. And on this trade, I believe this to be way oversold. 34 ticks, 28 is our limit. And ultimately, we get a really, really nice trade right here. Well, it's a little bit of a hanger too. Not the most conservative. Here's your great trade. Right here. Really, really tight to resistance to the upside. You've got bias. You've got order flow and momentum. You've cleared all these pivots. And you've got nothing to stop the trade from going to the downside. And that's a gigantic trade. Now remember, you're only looking for 2 of these in a day to make $800 a day. Now you lose bias and the market stutter steps its way up. We don't care. And there's our move to the upside. The break, the retracement. Now here we don't have order flow and momentum. Maybe you want to take the trade, maybe you don't. Here's the second retracement in the trend. This one does have order flow and momentum. It does have green bias, and each of the colors signifies something different. It goes 17 ticks. Now I'll show you a trade that I took that failed. This is a trade that I took. It was a break. It was a retracement. And I took it too tight to the pivot. I'm looking for 10 on my first target. I got 9. So it was an unsuccessful trade. I missed this by a tick. So I could not get the candle body or the wick to push down one more additional tick. We have no bias here. We just ignore what's going on, and that's it. I'll quickly show you the ES. I don't want to wear you out. We also trade the ES on a 5 range. And I just have to just hit this, and bias will come back into the chart. Ninja's funny sometimes with fractal indicators. There we go. So let's go back. Weren't great trades on the ES. No bias here. We're not going to touch these trades. Now we have down bias. We have nothing to trade. That's an oversold market. We're way off of support. 2 miles off of support. This is way overbought. So today on the ES, zilch. And sometimes we get great trades. But I had a terrific trade on bonds. I'll just show you that really quickly, if I can find bonds. Hold on one second. Now bonds are $32 a tick. Show you the trade. Same thing. We traded 3 range bonds. And there was the trade. The break, the retracement. It was only 2 ticks off the 15, and it pushed down for 9 ticks. Now, I got a little skittish on it, and I took all 4 contracts out at 3. And that was still a $360 trade, something like that, because it's $32 a tick times 12 ticks. So it was a $350 and change trade. It's a very, very successful trade. And our ATM strategy is we take 3 off at 3, and the 4th we would have taken off at 5. So it cost us $60 on the trade by exiting it a little bit early. But it was a perfect setup, order flow and momentum, bias, 50 down, 15's down, and away we go. And I don't think there was anything else. No, there's another one. This is really evening. Big move to the downside. Really a nice trade. So that's bonds. So that's the platform. It's very intuitive and very, very, very easy to trade. Let me just go back to the slides for a second. Hold on one sec. Now you can see you can see this is not a black box system. I mean, we show you what you're doing and allow you to analyze the trades, understanding all the variables that are required to get a successful trade. Now, we provide you with software that I really do believe provides you, that does all the heavy lifting for you. It gives you 90% of the information you need to take a successful trade. And remember, to be successful, we're the commercial traders. We have to outfight the institutional guys. And it's hard to beat them up. They have so much money, and they're so rich, and they use very sophisticated trading systems. When I used to follow the tape, they bang through 50, 100, 100 lot over and over and over again. Unfortunately, what we're stuck doing is taking money out of the other commercial traders. And those are all the traders that counter trend trade, try to call tops, and try to call bottoms. And a lot of what we do is based on education, because 10% of trading is discretionary. It's knowing when to give the trade a little extra room. If it's 5 ticks off the 15, it's okay. If you're a little overbought, it's okay. If you're a little oversold, it's okay. It's understanding all the parameters in a trade that define risk, and you get a system-generated entry and believe that that provides you with a safe enough trade, provides you with enough precision to get into the trade. So we provide you with extensive videos, group and personal mentorship programs, and we really support our software. I mean, we're here 24/7, and we get 1 million phone calls, and we answer them, and we're here. And I trade this system every single day. I don't hide under a rock, and I don't have a website with no phone number. And the thing is that we never ask you to. I think it's nuts to ask someone to pay for a boot camp, because a boot camp, I think, is almost like an admission that, well, the information we gave you initially is insufficient. So what we're going to do now is we're going to ask for more money from you, so we can make you profitable, but you have to buy our boot camp. And we don't ever do that. And we have many people who have been with us a long time. Every time we create a new indicator, we always give it out for free. We give free upgrades for life. So we don't have like a 2.0 version when you have to pay $999. I don't believe that's ethical. So when we created the background bias indicator, we gave it out. Every time we come up with a new idea to try to get our trading family profitable, we give it out for free. So what we're going to do is we really want you, I'm going to go, we have a webinar special. It'll be available for a couple of days. It's the entire software suite. There's the link to the special. Now we have a system, I don't want to run over time too much, called direct entry software. On the direct entry software, I take the trades for you. I not only call them out in the room, but we have software that we install in your computer, and it actually puts the trade in your NinjaTrader. So not only do you get the verbal entry, you actually get the call on your Ninja. And I manage the whole trade for you. Sometimes I exit them early. Sometimes we move up the stop. All of these directives are sent directly to your NinjaTrader. So you can kind of sit on your hands. But I think trading over my shoulder and understanding the system really well will serve you better. And we have people in the room that are just absolutely superlative traders. You get 2 hours of personal mentorship with me. You get 2 months in the live trading room, and it's $29.99. Now, what we really want you to do is to sign up for a free trial to our trading room. Leo's going to put the link in there now. And all you've got to do is just go, sign up, and we'll put you in the room for a week. We'll let you see how we trade. I think the more you learn about our software, the more likely you're going to be to stay with us. Now, there's the link directly to the sign-up page for the free trial. If you go to www.rightlinetrading.com, there's a link to our daily net equity in the trading room, a link to our daily net equity on the auto trader. There's the sign-up for the free trial. There's also a contact us page. You can email us directly at info. And our phone number is it's on our website. It's 855-765-6681. We're really very, very available. We're very heavy duty tech oriented because we have the direct entry system and put the trades directly on your platform. We have to have really good tech support, and we do. I mean, Leo's here. He's absolutely outstanding. We have an auto trader. It's a separate piece of software. We're about to release our ES Auto Trader. Right now, our Auto Trader trades crude, Russell, and gold. It's taken 8 trades this month, and they're all winners. It's 8 out of 8. It's trading 100% this month. If you want any information about it, you're welcome to call us. We're going to add an ES Auto Trader. Everybody who has the other Auto Trader will get that for free. Everyone who doesn't have it, it will go in as a separate. It won't be an add-on. It's going to be a separate auto that you're going to have to leave separately. But as a member of our family, you always get our upgrades and our add-ons. So if there are any questions, you can ask them. Feel free to ask them now. Does anybody have any questions about the system? Will it work on a sub-account? I'm not sure what a sub-account is, EV. You know, if you have a data feed and you're live on Ninja, I don't see why not. I mean, if you have, I mean, the only thing that we need to get you started is your machine ID number, so we can configure the software. And if you have a CQG or a Continuum or any one of those data feeds, you're good to go. I don't think it makes any difference. Yes, CQG makes no difference because that's a broker issue on your end. We don't even look at the broker issues. Something, if I had the time, Iron Man, I would go back and show you some of the trades I took. I really extended myself and took a couple of really, really aggressive trades that didn't work. I showed you one of the losers. I could have showed you a couple of the others. And you'll see it posted. Hold on one second. How do you keep... Well, listen, we're trading a 13 range, so the trades do not mature fast. And, basically, in the course of a day, there may be 3 or 4 or 5 trades on all these markets combined. I mean, we're only looking to take a trade with background bias. So when a market just has a white background, you don't have to really study it. And the 13 range is we used to trade an 8. And so it's really not that difficult. 2, we give you an initial license, and if you wanted an additional one, we do that for you free of charge. No, we have not changed the auto to a 13. It still trades an 8. I trade 6. The Russell, gold, crude, the ES, notes, and bonds. It depends how many contracts you want to trade. We recommend to trade 3 contracts on crude gold and crude and gold. That's going to cost you $3,000 of margin. So you're probably going to need about $3,500 to $4,000. If you just want to trade bonds, notes, and the ES, that's only $500 a contract. You can start with about $2,000. No, it's not the reason, Iron Man. Here's the reason why we went to the 13 range. And really what you asked is a really, really good question. And I hope everyone will give me 1 minute to explain this. Remember that we take buy stop and sell stop orders. So we're demanding from the market. A lot of rooms give you areas to take a trade. They don't give you an exact entry, and I do. We have a lot of people in the trading room, and a lot of people are on direct entry. So let's say that throws 150 or more contracts into an order right at a specific tick level on the Russell or gold. Well, there's oftentimes not enough liquidity to get everyone filled. So what happens is we were starting to get a lot of feedback. Hold on one sec. They were starting to get a lot of feedback they were getting slippage. So what we do with the direct entry system in order to avoid it. Now, so what we did on the 8 range is we went to an entry only on a pullback. The trade had to hit our entry and would only execute on a 1-tick pullback. That eliminated slippage as an issue. But on an 8 range candle, you oftentimes don't get a wick. So the trade would just shoot, and I had one of those today on a 13 range. And when about 17 or 18 ticks, didn't produce a wick, and none of us got in the trade. But most 13 range trades have a 1 or 2 tick wick, which gets everyone into the trade at the same price and eliminates slippage. So that's why I went to the 13 range. Most rooms don't give a hoot about your slippage. They just give you market orders, and you get them as best you can. If they recommend the market order of 100, and you get 102 or 103, that's your issue. And they don't deal with it. But we do. What we try to do, because we have the power of the direct entry, as soon as the trade triggers, it doesn't execute until that candle shoots a 1 or 2 tick wick back through. And it also gives you a premium on the trade, because as soon as it hits your actual entry, you're already up a tick. So our 10 tick first target's really 11. Our 20 tick first target's really 21. And our 15 tick stop is really 14. That's why our profit loss gives us more profit than loss on a trade. And that's why we went to the 13 range. We were doing great with the 8. We've got too many people in a trade, and the 13 range totally eliminates that issue. Listen, direct entry are my trades. I mean, I engage them, so the trading room is all discretionary. I mean, basically, if I trade bad, the direct entry is bad. Today I had a rugged day. I didn't do that well. I'm not going to hide that. But in analyzing my trades, I took a few trades without bias. And you know what happens a lot of times is when you get multiple winning days in a row, you start to get a little complacent. And every now and then you need the market to give you a swift kick in the butt to see that if you don't stay focused and stay very specific, you're going to wind up, the market's going to decapitate you. That's absolutely true. We have a year and a half of results posted on the website. So, you know something? We had a down day today, and honestly, really what matters is consistency. And sometimes let me just tell you this. You can, as long as you go back on a down day and analyze all your trades, which you should do on a winning day as well. I mean, analyze the trades you let go, the trades you took. If you have one loser, analyze it. You learn from your mistakes. And as long as you don't make them again, it's really okay. That's what professional day trading is all about. You're going to have a drawdown day. And occasionally it'll be a big day. But if 9 out of 10 of your trading sessions are successful, it's just part of doing business. You don't have to. No, Evie. If you want to be on the direct entry system, you can override any trade I take with the press of a button. So basically, if you see a trade I take and you see, this is what a lot of people in the room do, and they really use this to tremendous advantage. If I take a trade that they think is a little too aggressive, they can stop the trade. So basically, you're the final arbiter as to whether or not you want a direct entry signal to go. Now, I recommend you take all my trades, but ultimately you do not have to if you're on direct entry. And you don't have to be on direct entry at all. I still call the trades out, and you can still take them manually. You don't have to be on direct entry. You know, Michael, there's no lifetime access, but if you want to work something out, just give me a call. And here's the thing. The reason we give you the 2 months is because we really find that a huge percentage of our traders become profitable day traders. And so after the 2 months, when you're in for 90 days, the $239 for the to stay in the room is really just the cost of doing business. No, there is no limit on direct entry. That's why we moved to a 13 range. Absolutely, one contract works fine because we're all out at target 1. On one contract, on a 13 range, you're going to risk $90. You're going to risk $140 to make 110. So the risk to reward's going to be a little bit skewed against you, but 80% or greater of our traders are profitable. So you should do fine with one contract. I don't recommend leaving the computer on the direct entry system. I really want to be honest with you. It's a fabulous system, but I don't recommend you leaving it unattended. If you want a system that you trade unattended, you use the auto trader. The direct entry system, 99% of the time, will work fine unattended. Every now and then, it won't. So you have to watch it. Well, listen, it's getting late. I'm going to let everybody go. Come into the room. Watch me trade. You can come in Thursday and Friday. You guys can come in also next week, Monday, Tuesday, and Wednesday. And I talk through every trade. And everybody in the room always asks me, why did you take that trade? Why did you take that trade? So you're going to really learn a lot from that free trial. And really, 99% of all your questions are going to get answered. So listen, everyone, have a really, really great evening. Thank you so much for your time, because I know it's really late. But come on into the room tomorrow. We welcome everyone. And I really, really sincerely believe you're going to like what you see. And I don't ask you to purchase my software. I ask you to let me show you how it works. Thank you so much. I really appreciate the compliment. Everybody have a wonderful evening. We will see you hopefully in the trading room tomorrow morning.